Hello and welcome. Welcome, all of you who have attended. We expect some more to be popping in, but we thought we would get started to keep you guys engaged and so you wouldn't leave. Thank you so much for attending. And we hope to provide a real engaging conversation about Regulation A and crowd financed IPOs. Now, from those of you who registered, it appears that many of you are companies that are looking for an alternative path to, an alternative path to a traditional IPO to go public. And some of you are professionals that are looking for perhaps some nuances or an alternative. But I think some of you out there, just from my experience, possibly could be naysayers and don't understand or don't yet appreciate the value or the viability of Reg A. And I don't want to say we're here to disrupt that, but we do want to speak into the possibility that it might be something that you hadn't previously considered, because those of us here know that there's certainly a lot to be gained from this alternative. And I know I speak for myself and probably everyone here, particularly Mark Lenowitz, that equity crowdfunding and a crowd-financed IPO is likely the future of capital formation for companies. And we're going to be going into why we believe that is, and a lot of other, I think, important points that hopefully you'll walk away and feel like you've really learned something. And what we'd like to do throughout is be a little more casual than you might observe on some other webinars. We're all going to be talking about various things, and we welcome questions in the chat throughout. And we hope to provide value to all of those in the room, even though you may come from a different perspective. So what we're going to cover broadly before we introduce ourselves is, what is Reg A? How can it be utilized and for an exchange listing? And what makes it really different from a traditional IPO? And we're going to go back in time a little without getting too detailed, but we're going to talk a little bit about the Jobs Act and what Reg A used to look like versus what it looks like now, and why things are really a little bit different and a little more useful. I'm going to talk a little bit about kind of the steps legally and some non-legal steps that need to be taken in order to get to a qualified Reg A. And, Jay's going to talk quite a bit about, the Nasdaq listing requirements. But Mark is really going to be the heart and soul of this conversation. He's done a tremendous amount of work in this space and is extraordinarily insightful. And I'm really looking forward for us to have this discussion with you. And we encourage all of you not only to ask questions in the chat, like I said, but feel free to follow up with us. So with that, let me kick off going around the room and having us introduce ourselves. Mark, why don't you start? And then Matt and Jay, I'll tell you a little bit about myself, and then we can get started.
Great, Andrea. Thank you. And as Andrea just said, we really are excited that you're all joining us here today. Again, feel free to ask comments or questions throughout as we present. We'll be able to see your questions live. We wanted to make it a little more interactive rather than just each of us saying something and then having the Q&A at the end. A little background, my name is Mark Lenowitz. I am the Managing Director of Digital Offering. We are in a boutique investment bank, very active in the crowd finance space. We are a traditional investment banking firm that we do primary offerings, secondaries, follow-ons, and other types of structured finance opportunities. But what we've really tried to focus on, which we're going to talk about today, is new ways of being able to create capital formation for entrepreneurs and for companies, and to be able to navigate this terrible market we've seen in the small cap arena over the last 2 years, and really give an opportunity for companies to be able to get benefit, but more importantly, also for investors to get benefit as well.
Thanks, Mark. Thanks, Andrea. Hi, everybody. Matt Goldstein. I'm one of the founders of the Dealmaker Group of companies. Used to practice, was a practicing attorney in the capital markets for the first 10 years of my career. What is Dealmaker? Dealmaker is really an e-commerce platform. An e-commerce platform where the products being sold aren't shoes or shirts or concert tickets, but shares. And so what do I mean by e-commerce? Well, every brand that's able to build some traction out there has a value prop, or the founder has a track record. There's an attractive price, and the task for the company is to pierce through the noise of the internet and send a signal to the people who are a good fit for what that company sells. Now, in order to get anybody to buy anything, you have to do a few key things. You have to win their trust. You have to be, an attractive value prop as compared to alternatives. And you have to be able to tell your story in a way that resonates with the people who are a fit. In our view, raising capital is exactly the same. It follows the same required steps, and 9 out of the 10 things you need to do as a brand to build a community and to have people support your brand, you have to do in raising capital anyway. And so Dealmaker emerged as a platform for brands to turn their stakeholders, fans, and community members, customers into a source of capital as well. And Reg A is a major regulatory regime through which a lot of the brands on Dealmaker are turning their customers into a source of capital. It's not the only one. We did the Green Bay Packers common stock offering, and that was hundreds of thousands of fans of that brand saying, I also want to be an owner. Now, they didn't use Reg A, but when Congress created the Jobs Act and had the idea of leveraging the internet and opening up securities to everyday members of the public, it's exactly that kind of paradigm in mind. There's so much eagerness from the public to find and own companies that they have some sort of affinity with, if only that those companies can tell their story in a way that reaches them and can use the medium of the internet to communicate effectively. And that's really where we specialize.
Fabulous. Thank you so much for that. Jay, kicking it to you.
Great. And so everybody, thank you for the time. Again, my name is Jay Heller. I head capital markets at Nasdaq. I've been with the exchange coming up on 16 years. And throughout that time, I've been very fortunate, and I've had the privilege and the pleasure to welcome approximately about 3,000 IPOs join us on the exchange. It's really our goal in regards to an education process. One, what does it take for a company to be listed on the exchange? Can we qualify? What are the criteria? Look, it's important to note we are a regulated entity. And so therefore, there are requirements that are set forth and that are public. And ultimately, if a corporate is able to meet those criteria, then we would welcome nothing more than to partner with any company from around the world, regardless of size and stature or sector. It's the listing, for me personally, that I believe is the vehicle to really help corporates further their lifespan, whether that vehicle is going to be used for M&A, for employees to feed their families, for the means to raise capital. We've worked with Mark and Matt over the years on various listings, and they've been very successful. And we look forward to the future as to what holds. So I thank everybody for joining today and look forward to the conversation.
Excellent. Thank you so much for that. So I am Andrea Cattaneo. I am a partner with the law firm of Mitchell, Silberberg, and Knupp, often abbreviated MSK. Firm was founded in 1908. And while we've got many practice areas, and one of our most recognized is entertainment, we represent Disney and Sony and MGM and the Grammys, we've got a thriving and busy capital markets team, and that's where I serve out of our New York office. We're also in Los Angeles, we're in DC, and over the past 25 years, I have worked on or led over 200 capital markets transactions. I've taken companies public in various ways. I've worked on everything from de-SPACs, reverse mergers, IPOs, Form 10s, even 15C211s back in the day when companies just wanted to trade on the pink. So really all over the map, Reg A's. What I've seen so much over the years are, differences in paths that are appropriate for companies based on what their criteria is. It's often a discussion which way a company ought to seek capital. And it's not for everyone to go public. What we're really going to be focusing on so much today is for those companies that are eligible to list, this is a true viable path for getting listed using Regulation A as an alternative to what we would typically do in an IPO, which is file an S1 registration statement. So I want to back up for a moment for those of you who may not be super familiar with really the process. I don't want to use jargon like S1 and certain other filings without really explaining just some basic fundamentals, because I do see that some of you may be new to this process. So for purposes of selling securities, if a company wants to sell a security, they basically have two broad choices at the beginning. They either can register those securities with the Securities and Exchange Commission or rely on an exemption from registration. And many of you are familiar with various exemptions. You may have done a private placement under Reg D. Regulation A is an exemption. You're going to hear a little bit as we discuss things that it almost functions like a registration statement. In fact, in the process we're really going to be focusing on today, it feels a lot like a registration statement because it's requiring a lot of the same disclosure. But the facts remain, it's an exemption from registration. And there are many things that make it a little bit different from an S1 registration. There are various steps that I'm going to go into detail on in a moment, but I think what we'll do first is have Mark speak a little bit more about what he sees going on in the marketplace and why this has really functioned as an ideal pathway for companies that qualify for a listing and want perhaps a lower expense, a shorter timeline. Some of the other advantages we'll talk about include the ability to communicate. There's no quiet period. I think that's a huge advantage. And we'll talk a little bit about testing the waters. And I think Mark and I agree that that's not particularly useful. But Mark, I'm going to send it to you for a moment and then come back with some of the more dry aspects of the process.
Thanks, Andrea. So if I backtrack a little bit, let's go back into 2015. And in 2015 is when Jobs Act really came into play. And there were three areas of Jobs Acts that everybody got excited about. There was what's called Title II, which is the general solicitation of private placements. There's Title III, which was Regulation CF, which is crowdfunding. And then there was Title IV, which was Reg A+. And it's important in this conversation that we're not talking, when we use the word crowdfunding or crowd-financed, we're not talking about Reg CF. Reg CF limits the ability to raise only up to $5 million. And those securities are restricted for a 12-month period and can only be offered directly through a regulated platform. What we looked at was when we saw Jobs Act and Title IV, which was Reg A+, at the time you had the ability to raise up to 50 million. You currently have the ability to raise up to 75 million. We looked at it and got excited because this was truly a modernization of capital formation. And what I mean by that is all of us down the street have been used to doing what's a traditional IPO. And as Andrea just mentioned, an IPO is a registration. The form of registration is called an S1. And when a company goes into that process and begins working with a banker, what happens is the company needs to go into a quiet period. And during that time, during the marketing time, there's a red herring that's filed. And there are very restrictive rules and regulations on how the company communicates to the public and how the banker can communicate to the public. And then ultimately how price discovery works, where the banker will take the company around on a roadshow and meet with institutions and get price discovery and then work towards a point where the company becomes what's called effective in its registration. They price, they sell, and it opens for trading the next day. Well, that does not work in a modern society. Everybody today utilizes their cell phones, the Instagram, the immediate need for information and content. And things are moving so fast that if a company needs to go into a quiet period, it really isn't effective, because if you think about the whole idea is to be able to give investors accurate and current information that they can make informed decisions about. But if the company can't communicate other than an ordinary course of business, is the client or is the customer really getting the adequate disclosure of information that they need? So what Reg A did is it changed that. It allowed the ability for investors now to be able to see real-time data. Companies could communicate using social media, using Facebook, using Instagram, and other types of videos. And that's what Matt's team does, where they design this. But if you think about the other opportunity, is that if you're an investor and an everyday retail investor, it's unlikely that you're going to go and do a roadshow and visit the company or walk through the factory or see how those widgets are made. But the use of Reg A and the use of videos, you can now actually be transported directly there through that video and be able to experience what's going on. As an issuer, when you're looking at doing Reg A, it also gives you the ability to convert your customers, followers, and affinity members into shareholders, but you're also, through your marketing of the actual offering, converting many shareholders into customers. So it's two bites at the apple. So it truly revolutionizes the way that you can communicate to a customer base and a shareholder base, which ultimately, hopefully, would drive revenue to increase and ultimately have a better performing stock in the end. The other benefit, and the reason that we're excited about Reg A, and we'll get deeper into this here as we go on. Unfortunately, 2022 and 2023 has been a devastating year for small cap underwriting. The reality is deals are not getting done like they used to. 2021 was a great year. Every banker was happy, stocks were going up, and deals were getting done. But for the last year and a half, or really going on 2 years, it's been absolutely terrible, where we've seen a transition from investor, or rather issuer-driven deals, where deals were priced based upon fundamentals and based upon price discovery of where the company is today and where it's going. Deals have gone from larger deals to being downsized, and deals have gone from valuations that were realistic to valuations that are in favor and benefit the shareholder, which happens to be an institution, rather than the issuer and the other original shareholders. And we're seeing these types of transactions convert into what we call structured finance, where you have a unit offering of a share of common stock and maybe sometimes 100% or even 200% warrant coverage. So the CEOs get confused because their IPO comes out, the deal's priced at $5, and the next day the stock's at $2 and going lower. Because these institutions will sell the positions out of the common and hold the warrant, because the warrant on an intrinsic value and a time value is worth a lot more than that common stock. Reg A does away with that, because what happens in our offerings, and if you're going to utilize Reg A, is you don't have 4 or 5 institutions, and you're not going in to get 301 or 310 shareholders so you can qualify for Nasdaq, and Jay and the listing teams are happy with you. But this is the true definition of a diversified offering. Most of the transactions that we've completed over the last year, we've seen anywhere from 8 to 20,000 investors participate. So you have anywhere from $500 to $1,500 per investor, and it's diversified, where these investors believe in what management's doing and want to have the ability to give the company the capital to execute and be able to grow that business. So it's really taken old school investment banking and modernized it to the new way of being able to create capital formation and leveling the playing field, allow Main Street to finally participate side by side with the institutional world and Wall Street. And I think we saw it with GameStop and Wall Street Bets, and everything that happened.
Absolutely.
Power of the crowd, it's there. And this
It is. And you made such important points. And, the process is considerably faster than with a traditional IPO. And we'll say this more than once, while early stage companies, private companies, even public companies can utilize Reg A, which was not the case at the onset. For purposes of this conversation, using Reg A as an alternative IPO path, we're really looking to have companies that are ready with audited financial statements who would qualify for what is a tier 2. And just briefly, tier 1 and tier 2 is the breakdown of categories where companies can utilize Reg A. In a tier 1, it's up to $20 million that can be raised. The real differentiator is that's for companies that don't have their financial statements audited yet. And that's really not a company that's eligible to list. That would be a company that perhaps would be filing a 15C211, which is a form that's filed with FINRA in order to get trading, and that's on OTC markets. And that's not what we're talking about here. The tier 2 category is now up to 75 million, as both Mark and I think Matt indicated. It was up to 50 million for a few years, and it was that rule was amended. Companies can raise up to that amount and be eligible to list if they have if they're tier two, have their financial statements audited, and the process to get qualified, and we use that term as opposed to having a registration statement go effective, is on average 75 days in comparison with a 120 to 180 day range for a registration statement. So, backing up a little bit to what does all of that look like? What does that include? It is very much an exercise in putting together a full disclosure prospectus, just like a company would if they were going public traditionally. And the requirements truly are a little bit more lax under Regulation SK, but that's not how we recommend a prospectus or an offering circular be put together, an information circular that goes with a Form S1. What we recommend is have the full disclosure that's required for an S1 and the level of acceptance and the just the manner in which the SEC examiners review a very thorough, well-written, compliant Form 1A. You're going to look at it more in line with what companies that file traditionally are providing, and the path to getting qualified is going to be that much quicker.
Well, Andrea, I'm going to interrupt you just on one aspect of that. And by the way, what we all talked about is we're going to interrupt each other here today, and none of us are going to get upset with it. I just want to say it's actually not that much faster. Andrea is absolutely correct with sometimes the SEC review process will be quicker, and the response time, they tend to work quite well with the registrants that are filing. But the reality is that you're still doing an underwritten deal with an investment banker. And there are other requirements that require us to file with FINRA and go through 5110 comp. We have to work with Nasdaq, and that process takes time. So it's realistic to expect that this is going to be a minimum of a 90 to 120 day period, for which at point you're going to be able to actually go out and sell the securities. And then Matt and his team comes in and designs anywhere from a 60 to 90 day period for the securities to actually be marketed. And during that time, all of that money starts coming into escrow. So you as the issuer have the ability to see that what's happening in the market and how that's translating into media buys and how you actually have the cash. So then at the end of the offering period, unlike in a traditional IPO where the bank is out talking to institutions hoping to get an order book, we go to Nasdaq 2 weeks before, and we're already well qualified with thousands of investors and millions of dollars in the account that it's now able to close with or without street participation. So it's a great process, as Andrew said, to go through the SEC in a faster manner, but the second half of the transaction still takes about.
You are absolutely right. And, that brings us to really how important marketing is, and how in most circumstances, that's something that should be considered in advance before an underwriter is engaged. And things that an issuer, and we'll refer to a company as an issuer often because they're going to be issuing securities, the issuer will have an audit completed before having, before sitting even down with counsel or concurrently with that. And counsel will help with the preparation of this comprehensive document that looks a lot like a registration statement. And once the audit is done, really the timeline that, everyone goes through is kept pretty tight. You've got the professionals involved. You should have the auditors, the bankers, whoever is going to be your underwriter, and legal teams getting on a call maybe once a week to discuss progress and to get the filing ready to present to the SEC. And engaging a stock transfer agent is important at that early stage because there are just a lot of moving parts. So having really competent professionals around you who are familiar with the process, making sure that you have all the service providers lined up, you're just going to have a lot to handle once you're public. And along those lines, even interviewing investor relations firms, because that's all kind of the same as when you eventually are public. After you ring that bell, you're going to have a need for market support. And Mark is going to talk to you a bit about how things might be a little bit different if the structure is not typical with common stock. And
I'll just jump in there because I think it's important to add the point that, we always tell founders or issuers not to think of capital raising under Reg A as a, transactional experience that has a starting moment in time and a finishing moment. I see a lot of the questions about the timeline and how soon. And, for us, the development of a community that can be supporting the issuer in a capital raise or after, a public listing, as a community that's engaged and, supports the stock or buys the company's products, is really an army of loyalists for the company. Mark mentioned GameStop, and Jay and I have talked at length about, how issuers, once they're public, still need to make sure that they're engaging their communities and, really, sharing content with them and providing visibility. All of the energy that brands have, the loyalty, and some people call it, to evangelize a stock or to be an ambassador for the stock. All of that energy can be put to use for the benefit of the issuer through Reg A. But that comes with a mindset around continually building that community, continually telling the story, continually making, senior management available to, potential stockholders or existing stockholders, and, treating investors like a community and like an asset, not just a one moment in time, I need capital, I'm going to go out to these people, but really I'm going to use the framework that Congress authorized and augmented in 2015 to build a community that will support the company in a capital raise and, as a public stock.
Absolutely. And thank you so much for that. We just got a question in the chat. How does 506C factor into a path to going public? And I'll just briefly address that. 506C is an exemption under Regulation D of the Securities Act of 1933. It's another exemption, an alternative to Reg A. Private companies use it. Public companies can use it as well. It is for all accredited investors, and it is nuanced in that, unlike other Reg D, like 506B, other Reg D exemptions, the accredited investors have to vouch for their accredited status, and it's up to the company, the issuer, to confirm and verify that by getting bank statements or tax returns, or by having an independent verifier do that higher level authentication or verification that investor is accredited. And yes, it's a certainly wonderful resource. All of the crowdfunding exemptions really do provide what Matt was talking about, the ability to communicate with the public, which you couldn't otherwise do under different exemptions. It makes it easier to cast a wider net. And that certainly is a good potential step one if a company is looking to raise some initial capital, maybe before looking to do a Reg A and use accredited and non-accredited investors, because Reg A permits both. And sometimes a company that has, let's say, a big affinity group, maybe it's a consumer products company or a company with real estate or a music company. And frankly, it doesn't have to be a company that has products or an affinity group. It just happens to work well if you have customers. But sometimes a lot of those customers are non-accredited and they would love to be shareholders. What's happening today, what we're seeing a lot of today, is people who like a company would love to become shareholders, never had that option before, didn't realize how easy it is. And today's modern investor can open up an account on their mobile relatively easily and get into the game, which Reg A provides them with. Go ahead, Matt.
Well, when I was practicing, a private placement was like you'd email out a bunch of subscription agreements and investors would have to figure out which exemptions they are eligible for, and they tick this box, and if they're in Canada they take a different box, and then there's some sort of like paper-based process of looking at the stack. In the modern world, right, to go back to kind of the picture Mark was painting at the outset, in the modern world, everyone's online. Everyone's using their mobile phones.
Yep.
And, we bought a Peloton the other day. I won't tell you how much we paid for it, but like it's
I bet it
more
was
than the average. It was more than the average person, spends buying more than the average retail person spends buying a stock in one of these online exemptions. So the buying pattern of the U.S. public has changed since 2015. We live in an online world, and people expect immediate ability to buy and sell without friction, without barriers, without huge hoops to jump through. And I think Reg A has been brilliant at unlocking some of that
Yes.
energy from people who just want to buy and sell shares.
Now, let me just, Andrea, if you don't mind, I'm just going
Yeah, go
to
ahead.
expand on that because I think there's a couple questions here and it ties back to 506C. And some of the questions are, can Reg A be used for a non-traded asset class? And the answer is yes. And we actually, at our firm, we use a combination of all the exemptions that are available in order to create capital that would be appropriate for the company at different stages of its life cycle. So as Matt just said, the whole key is being able to allow non-accredited investors to participate. Reg A does that. You can market across all 50 states without having to worry about blue sky filings or state filings for that particular offering. Where Reg D, you do have to work with it. We have a client that we raised $18.5 million for, non-traded Reg A, from over 8,000 investors last fall in 2022. We are now in the market doing a 506C. At the same time, we're filing a Reg A for a public offering. And the reason is that there's no integration. So you can still use Reg D 506C for your larger institutions, your larger accredited investors, your bigger ticket writers, where we can use discounts. For instance, what we do in our structure is those larger investors would receive a 25% discount to the public offering price. So we did $18.5 million first with 8,000 investors. We're now raising up to $10 million in a private, and we're getting ready to file a $20 million Reg A, where we'll probably have another 8,000 to 10,000 investors. When that company comes public, it's going to have over, hopefully, close to 20,000 investors, which is going to be a mix of institutions, retail, and accredited high net worth. So that truly, as I said earlier, allows the diversification of the offering to occur.
So can I ask Jay a question then? Because
please.
I'd be curious as to whether just following Mark's kind of point, does the exchange have a view, right? When a security has a large number of retail investors, like what Mark's talking about, 8,000 people, 10,000 people, versus a small number of, like, how does the exchange think about that?
Look, it's a great question, and I would say one from the regulatory side, which I'm not, and I got to make that very clear. I'm not one of our regulators. I work very closely with them. We're regulated by the commission, right? So there are rules and structures and a pathway for corporates to be listed. And it's not for us to figure out how you raised your capital. There are minimum requirements in regards to your shareholders, but I don't think we're ever going to get caught up and say you have too many shareholders. I think distribution is always going to be very positive in this type of environment. So the core minimum, at Nasdaq is we don't dictate to anybody how you raise your capital and what type of structure you should pick. So if it's going to be the 1A, if it's going to be the S1, if it's going to be an F1 or S11, we can go on and on and on and on and discuss all the various structures. That's not what we do. We truly try to support corporates at any point in time. And they have to work with their partners, right? on the legal side, on the underwriting side, if you're going to be using the Reg A side, to ultimately figure out a pathway that these are the criteria. It's your net income standard. It's your market value standard. It's your how do I find the path to Nasdaq? And then we have a 3-tiered model. We have our capital market, which is geared more towards companies starting to, get a little bit of a sail behind them. You grow up a little bit, you're more established, you're getting larger in scale, you step to the global market. And then we have the Nasdaq Global Select, which has the most stringent listing qualifications of any exchange out there. But the nice thing is, it's not like you have to pick A, B, and C. you can find the criteria that works best. So if it's net income, great, fantastic. Or if you've been in business for a few years and we're not generating income as of yet, well, you can use that standard. If you want to look at the market value standard on the capital market, okay, we're not going to raise a lot of capital, but we want to meet the net standard or the net minimums, but we do have a market value of publicly held shares of 50 million. Can we do it? And the answer is yes. So we're never going to tell you what you have to meet or what criteria you should. You just have to figure out with your counsel what is the best path forward for us. Because again, we're not in the business of picking winners and losers, and we do not say we think you do qualify, but we just don't really understand who you are and what you do. Again, here's the criteria. It's all regulated. I think the biggest thing is at Nasdaq, if we could find a pathway to allow you to have that vehicle and for that entity to be listed on the exchange, that's your gateway. And then obviously you take over with the marketing post. And if there's needs for capital, obviously you engage your partners there. But the biggest thing is always shareholder count at a minimum perspective. So on the capital market, it's going to be 300. Round lot shareholders, a round lot consists of owning 100 shares. The global market, which is a step up, a little bit higher criteria, you're going to need 400 round lot shareholders. And then if you have your thoughts and dreams to be on the Nasdaq Global Select, you need 450 round lot shareholders. And there's other criterias as well along the way. But no, again, I wouldn't say, and I don't think there's an opinion as to having too many shareholders. I think for the most part is look at the company. Is it a viable investment for individuals to deploy their hardworking capital? Those are not decisions in which we get into. Ultimately, we want to support companies and be their partner, that when they do choose to partner with us, and we're thankful for every listing and for those that have engaged with us along the way, I say this and jokingly, you know, when the lights go off, and that's day one of your listing day, right? And the wedding is now over, and now you're married. And so you have to make sure that your bride or your spouse, or maybe your exchange of choice, is really going to be there to support you. And we feel that we have a very good networking ecosystem with our organic sources that we have, and ultimately with the partners in which we deploy to really support corporates along the way. It's truly that simple.
I think it's really important for people to hear because, you know, when I look at some of the securities that have huge amounts of retail energy behind them, right? Like I know you love all your children equally, but like I look at the Teslas of the world and they find their way to NASDAQ. And so, you know, when we get questions, and even in the chat, I see some questions, is it messy to have all these, you know, small shareholders? I look at some of those securities that have, you know, made their way to NASDAQ with huge numbers of, you know, small shareholders. And I think, well, how could that be a bad thing at all?
It's really not, Matt. And I can jump in from a banking perspective. One of the problems is that when you have a small shareholder base that's controlled and dominated by large institutions, unfortunately, then you're a victim of the whims of that particular institution. If they decide they want to exit, they decide it's not going to be something appropriate for them, there could be a lot of selling pressure. But when you have thousands of investors in a truly diversified offering, then you have a lot more ability. And also the other thing that comes with that is that every one of those shareholders should be an advocate for your products. They're all brand ambassadors that should be going out to the world and telling them that I'm a shareholder, I'm proud to be a part of this. And you're basically getting a viral effect that comes on. And that's important because we've seen that in the aftermarket trading of the companies that have been coming public using this type of methodology. And just to be clear, there's no difference in the end result when you're listed. The form of registration or quasi-registration or exemption that we're talking about, either S1 or Reg A, is how you're selling the securities to begin with. But the day you list on NASDAQ, you're just like everybody else going forward. So you have to go out and communicate to the street. You need to have an IR program. You need to be visible to attract investors, institutions, research coverage, and everything that comes with being a public company. Yeah. But when you have that diversified shareholder base, it will enable you to reach a greater audience and coming out almost like an orphan stock, unfortunately.
Yeah, thank you. That's a great point. I mean, look, ultimately, regardless how you get to the exchange and regardless of the vehicle, the end result is going to be you as a company, have you now delivered on what you have communicated? And now you're going to be held to that as a public company, right? You're going to have your quarterly earnings. You're going to provide guidance for the most part. And I can guarantee you, because we've seen this a lot throughout the course of the years, if you provide good guidance and you have earnings and you beat on the top and bottom line and people are really excited about where the company is today and where you're going in the future, hopefully, no guarantees in life, your stock price is going to exceed and it's going to accelerate over time. On the flip side, if I, as a corporate, have communicated that these are what you should expect in the next coming earnings calls, and unfortunately, I do not meet or exceed those, and my guidance is not as rosy as we were hopeful for in the past, well, it is a possibility that my performance metric going down and how you judge us based on our stock price could go down. So
Right.
you just have to get to the show first, but then ultimately, you have to perform and you have to deliver on what you communicate to all your investors.
A good point here, Andrea. Maybe you just want to take this one.
Yeah.
Somebody just said, so one thing that we didn't say is Reg A is only available for
U.S. and Canadian companies. Yeah,
So
I
foreign
mean, I wanted
issuers
to
need
get to some of these questions. So yeah, U.S. and Canadian companies, or if it's a foreign issuer, you have to have your operations here in the U.S. That's fairly strict, and certainly we'd be happy to have a conversation with you about how potentially to structure something. But you've got to have operations here in the U.S. in order to utilize this exemption. And just wanting to get to some of the other, and I could go into more detail, but perhaps we should have a one-on-one conversation unless any of you have something to add for that. But some of the other questions had to do with testing the waters, market cap, minimum listing, and so on. So, just kind of given the time, just briefly, testing the waters was one of the things that initially, when we saw Reg A, excited a lot of us in the industry. We thought, wow, this is a great way to find out what to expect, and then perhaps we can sort of build our plan around this expectation. And sometimes platforms like FINRA regulated platforms would have, something set up, or a company would set up a button on their website. So indications of interest could be tapped and someone could indicate how much they might invest. And unfortunately, in the final analysis, and I have a feeling both Matt and Mark can confirm this, those who indicated interest almost, I don't want to say almost never invested, but it was a significantly smaller amount of people might invest than those that indicated some interest. And perhaps the best way, if a company is really looking to test the waters, is really looking to find out how much interest there is in the company before going through this process to an IPO, is to raise some capital. A Reg CF is one good alternative, or a 506C. Sell some securities. That's how you can tell. That's how you can indicate interest, is if some securities are actually being sold. And Mark and Matt, I don't know how much you have to add on that, but that's been my experience.
Yeah.
Testing the waters really is kind of a waste of time. And that's
I think it's a complete waste of time. If there's no call to action, if you're spending money on marketing and getting people interested in your business, then there needs to be an end result that they can purchase that particular security. I think in expanding on that for a moment here on, there was a couple of questions. This actually all ties back into what this type of offering is. One of the questions was related to valuation. Yes. And how is that valuation determined? And it goes right back kind of to testing the waters, where this comes with great responsibility. Valuation analysis is more of an art than a science. And when you do a traditional IPO, valuation is determined by price discovery of institutions, where your bank will work with you and be able to create a model that would make sense to where you should be priced upon comps and peers. And what's happened, and I said this earlier, is in the old days, if the multiples are trading at 10 times, you'd probably price something around 8 so people have the ability to benefit. But in today's market, when those banks are going out and you think you're getting a 10 times multiple and you're thinking you're raising $20 million, that's coming back now that the banker's only able to get orders for $4 to $5 million, and your $100 million valuation is now $40 million. And you just spent all this time and money going through the process, and you're left with no choice but probably to take that money. With Reg A, that responsibility still lies on the banker and works with the company. But instead of having a voice, which is one institution, the voice needs to be a mature person in the room, which is going to be basing that valuation on comps and peers and realistic valuations, where the CEO looks in the mirror. And we have so many companies come to us, and there's been so many Reg A's that have been done by other banks and other groups and platforms out there, where the company maybe on a good day is worth 50 million and they're raising money at $3 billion. When that company comes public, it's going to go straight down. And I think, Jay, we've all seen it in the last year. There was a company, a few of them, that came out with unrealistic valuations. And then ultimately the street will price it based on where it should be, which was that original mature valuation that it should have been at the beginning. So if you tie that back to test the waters, using Reg CF and using Reg D506C, you can get an idea of what the pricing should be. And then you can use that to continue to model that when you come and you bring the company public, that comp and that value is based upon a realistic model that would be able to be supported not only in the primary issuance, but the secondary trading, which is most important.
Thank you so much for that expansion. I think this is super important to the discussion. And I want to just spend a quick moment on ongoing reporting obligations. The reality is, if the goal is to list, once you're ready to list and you're accepted as a public company, you're going to file what's called an 8A, and it's a fairly simple filing with the Securities and Exchange Commission. It converts you from a 33 Act company to a 34 Act company, a Securities Exchange Act company. So you've got your ongoing reporting obligations as a public 34 Act company, like 10Qs, 10Ks, 8Ks when you have a material event, et cetera. But let's say your listing gets delayed and you want to continue raising capital, or just as a company that has a qualified Reg A, you've got other things that you're going to have to do to be compliant with the exemption. So semi-annual reports have to be filed on it's called a 1SA. Current reports that are kind of like an 8K for those of you who are familiar with material events and things that trigger an 8K requirement. The 1U is kind of like that. Special financial reports on 1K and 1SA do have to be submitted. And if you're exiting, there's a 1Z. So you just want to keep that in mind for if it's taking a company and issuer a little bit longer to list, and perhaps the issuer decides that for maybe 6 months or some period of time, they want to, quote their stock on OTC markets, OTCQX, or not. You might not want to trade, but you still have to be compliant with the SEC filing obligations, and they exist. And I'm happy to discuss any of that further. Just doing a time check. We have 10 minutes. I'm going to take a look and see if there are other questions that we have not yet addressed. And guys, feel free to jump in. Someone asked, can I list anywhere? New York Stock Exchange, ASC. New York Stock Exchange, American, absolutely you can as well. I don't know, Mark, if you've been talking much to SIBO, if that's an alternative. I think that is as well. But there's probably a lot of good reasons with track record and such with Nasdaq. Mark, maybe you want to address some of the reasons why you've seen that to be optimal.
Yeah, I mean, when we created the ability for Reg A to trade as a listed security, the very first one that we did, and the first ever Reg A on a national securities exchange was on to the NYSE American. So they are open, and Nasdaq has been one of the great markets too that allows these companies to issue. And I also want to give the benefit out to the OTC markets too, because this is a great tool. Like, we closed a transaction about a month ago where we raised 10 million using Reg A for an OTC issuer. So it's not limited just to the exchanges. One of the things about Reg A is you're able to use it for a 34 Act reporting company. So what we found, and I just want to talk a little bit about how Reg A also, I said it could be used as a go public transaction, look, act, and feel like a traditional IPO, settle like a regular IPO, and trade on Nasdaq New York the next day like a regular IPO. But it can also be used for a non-traded asset like we did with our previous company, where a company raises the money, understands how to utilize that money to grow their business, allows them to execute, and then be ready to be able to maintain a market cap and be able to come listed. But there's also a new tool, and we have 3 companies we're currently doing this with that are already listed on Nasdaq. And these are companies that went through traditional IPOs and have been public for a year or 2 years. And unfortunately, their market cap is not reflective of the valuation of what the company should really be trading at. And this is due to artificial, I guess you want to say, issues related to maybe a toxic financing that they did, where there were short sellers, or all these other, conspiracy theories, and there's a lot of conspiracy theories about short selling out there. But the reality is the market dictated that this company is not worth what it was. So there's three of them, two I can specifically talk without giving names, that were $100 million, $200 million companies trading at $8, $10 a share. And they're now $2 million market caps, doing over 30, 40 million in revenue. These are companies that are worth a lot more than $2 million. So we're using Reg A as a non-traded asset class that can go out and use exactly what we're talking about today, social media and other ways to raise money separately, disconnected from the common stock, and allow the company to get a valuation that's realistic based upon as if they were private or never public. And then in time, we would list that preferred directly on Nasdaq as its own separate instrument that what someday will convert back into common. And it's good for the common shareholders because the dilution is not occurring at this really low, aggressive level. And at the same time, people are going to see this new product, this new widget, this new idea, and realize, wait a minute, common stock is trading at a $2 million market cap, and the company's doing 40 million in revenue and should be worth whatever it is based on comps. So we start to see price discovery and buying interest in common as well. So Reg A really has a lot of uses just beyond primary issuances. It can be used as secondary tools as well.
I see someone asked about onboarding process, initial setup fees. How can the company, move from Reg A? I think we covered some of that. I don't know how much more detail we want to get into in these last few minutes. I don't know that we left anything out with respect to the steps. Engaging an underwriter is recommended, preparing that Form 1A with a securities attorney, getting that information circular as compliant as possible, even more so than what is required, more in line with what an S1 would require. Filing the offering, the 1A and the information circular with the SEC, engaging a transfer agent, responding to SEC comments, which you'll get in about 30 days from the filing, and simultaneously preparing a listing application and working in conjunction with a marketing agent or platform like Dealmaker. Lots of sort of interim steps that you're going to be going through, but those are really the major things that you're going to be handling. And like Mark said, oftentimes you're going to be, as an issuer, making game day decisions depending on how things are going with the company and with the review process. And there are options if listing is not, perfect timing for whatever reason. If there are securities that are to be non-trading, your circumstances will dictate maybe another variation on this theme or on this path. But I'm hoping that what we made clear is this is a viable path, and there are a lot of nuances, and we'd be happy to follow up and discuss any of those nuances with you. And I'm going to scroll for a moment and see Jay, if you have any. Go ahead, Matt.
No, if you're going to ask Jay a question, great. I have a question for you guys after.
Okay. Yeah, I mean, Jay, what have you been seeing in terms of the just the kind of reaction and some of the deals that you've been seeing that have come in? I think you've probably seen a few of Mark's that have come in, and can you speak to what the experience has been and if you've found it to be markedly different from a traditional S1?
Yeah, I mean, look, although I can't speak on any company individually speaking, Mark and his team has done a fantastic job partnering with these corporates that are looking for a pathway to NASDAQ. Honestly, when it gets to my desk from the execution side, it really doesn't look any different. You've gone through the process of meeting all the listing qualifications. You've onboarded your counsel. You've onboarded, obviously, your banking partners. And so your consortium is all set. The capital is already being raised. For us, it's about the public listing and then how do we support you after the fact. So I think it's really about having the right team that's going to support you. And if this is the path in which you choose to ultimately guide your way to a public listing on the exchange, so be it. We're going to support you. And, Mark, I have known Mark for years and Matt for years. And, there's been many fantastic companies that have chosen to use this process and platform to go public. And so we'll support them, and kudos to them. And I'm sure we'll see many in the future. Look, right now, it's no surprise. I mean, the markets over the last few years have been challenging. I mean, let's just call it what it is. And the cost of capital has gone up, and it's been increasingly more difficult to raise capital in this environment. Now, I do think we're going to see some, hopefully loosening. Maybe we can say, and at some point in time next year, and looking very optimistic for 2024 and beyond. But regardless, as I said earlier, to me, whether it's an IPO or a direct listing, or some people say the SPAC word, I'm a very big believer in SPACs as well. Find the structure that works best for you. Find the partner that really resonates. Because without having the right team, it doesn't matter what you do or how you're going to list. You need the support going into it. You need the balance. You need people that you can rely on, that ultimately have told you how they're going to perform, and then hold them accountable for it. After the fact, if you can find your way to the exchange, there's nothing more than we want to see more companies listed here in the US, just the vehicle in itself. And I've said it before, when you are on the exchange, you can use that for so many other verticals, whether it's expansion, whether it's M&A, whether it's just allowing employees to feed their families. It's just amazing. So, I think Reg A is here to stay, and ultimately it's going to be up for the corporates to figure out what works best for them. And we'll be very welcome.
Matt, I got a question for you.
Shoot.
Do you, on the marketing side, how do you navigate getting that story out beyond just retail investors? How do you build an audience for what happens beyond the public once it comes listed? Do you continue that process? Do you continue to resonate and communicate the story so investors are still aware of it? Because I think aftermarket support is really important here too.
I agree. We always tell founders we don't look at capital raising as a kind of transaction with a transactional mindset. It has with the beginning and an end. We look at the act of community building as a continual exercise. So you're always engaging with your community, because if you want them to be there for when you do need to raise capital, you have to have started that process long before and established that track record of transparency and providing value and providing access, right? A lot of the companies we've done campaigns for, who are your clients as well, Mark, the CEOs are on webinars and they have open Q&As, and they engage in the type of community building that, you would expect from an already public company, like an already a company that's already trading on Nasdaq. They don't quite have earnings calls, but they use the same logic of engagement that they're going to need in the future to, kind of create the groundwork, to lay the groundwork for a community staying with them for a long time. It's just as important after the close of a raise as it is prior to the close of a raise, because we don't see a linear start and stop. We see a continuous effort, like our image is a flywheel. The more energy you feed into that flywheel, the faster it spins. And that, flywheel is the engagement between the issuer and its shareholders / stakeholders / customers.
Thank you so much. I know we've been talking amongst ourselves here, and I saw something pop up. Should we host, or should we do a part 2? I don't know if you've been collecting that information, Matt, but I think there's certainly more to be said. And I know we want to be respectful of everyone's time. It is 2:01. If there's one last question or a final comment that any of us would like to provide before we close, Jay, anything final you'd like to say?
No, I think I'll leave it with, I thank everybody for their time and thinking about engaging the capital market landscape. I'm around if anybody has any questions, so by all means, please feel free to reach out, and don't hesitate.
Thank you so much. Mark?
Yeah, I'm going to jump in and say that too. We love to look at your transactions. We are hoping that this industry continues to take off. If you're a competitor investment bank we'd love to partner with you. We think it's important that everybody in the industry understands that this is a viable tool. So it's not our toys and you can't play in our sandbox. It's the opposite. And as an issuer, if you come to us and you're too early, there's plenty of other bankers and groups that we work with that we would refer you over to, that you could get your first stages of capital and then come back and visit with us for the second part. And it's the same thing with, it's an ecosystem of the small cap arena of Wall Street. We're all friends. We've all worked together over the years. I'm 33 years in the business. Andrea is only 36 years old, so it hasn't been that long. But and Jay and all of us. So reach out to us as resources. Hopefully we can help you on a banking capacity, but if not, we'll certainly put you in the right direction and look forward to your success in your own capital raise.
Thank you. I echo, I'm going to let Matt have the final word, but I do echo those sentiments that this is a community of professionals that work very well together. And in terms of counsel representing issuers, counsel representing bankers, we tend to do continued relationship type of work. Like Matt said, it's not just a one-time transaction. It's really something that lasts until the company really is, at a level where hopefully they're going to continue to need all of us forever, or one day they're going to have their own experts in house. But thank you so much, all of you, for attending. We're going to discuss amongst ourselves if there's enough questions coming in, if we want to continue this conversation. And Matt, thank you so much for hosting. I think this was such an important discussion to have. Tons of interest, a lot of confusion about what Reg A really is. And I'm hoping that we were effective in conveying that this is really the future of capital formation.
Yeah, I join my colleagues in thanking everyone. Look, we're all in the business of trying to improve the capital markets, right? For issuers who are looking to raise capital and for investors who are, who just want to own something that they really love. So we're all allies in this common endeavor of, building the capital markets in a more efficient way. I'll just close by saying, based on what we're hearing from Mark, based on what we're hearing from Jay, based on what we're hearing from Andrea, now is a really good time to start thinking about these things. Right. By the time 2024 and rolls into 2025 and, all that activity we're expecting to see starts to hit the markets, it takes a while to build that up and to build the expertise and to craft the story and to line up your, all of the angles that you're going to need, and to get the advice from Mark on how to structure. Start now. We really, really encourage people to not wait. We encourage them to reach out, start now, start, coming to these things, getting educated, and start building, because things change very quickly.
Thanks, everyone.